Imagine you're holding a product so incredibly valuable, so fundamentally essential to the modern global economy, that the biggest tech companies in the world are begging to wire you cash in advance.
Right, just to secure a place in line.
Exactly. And you aren't brokering rare earth metals or crude oil, you are selling memory chips.
Wild to think about.
It really is. Welcome to this deep dive into the unprecedented supercycle of the memory semiconductor industry. We have got a massive stack of sources today.
Yeah, we are looking at 5 very intense back-to-back financial analyst reports.
From major Korean securities firms. So Kiwoom, Hana, IM, and Daishin.
And all of these were published just in January of 2026.
Our mission for this deep dive is to map out the sheer scale of this 2026 tech boom. We need to understand exactly why memory chips have suddenly become the world's most lucrative bottleneck.
Right, and we are also going to decode what this massive shift in pricing power means for the broader tech ecosystem and ultimately the gadgets you buy every single day.
Okay, let's unpack this. Because reading through this chronological timeline of analyst reports from January 2026, it feels less like reading financial projections and more like watching a dam break.
Yeah, there's a distinct sense of panic mixed with excitement in these pages.
Let's start the month. January 7th, Kiwoom Securities drops a report projecting SK Hynix's 2026 operating profit
At an incredible 103 trillion won.
with a target stock price of 880,000 won. I mean, in any normal year, an assessment like that would be the high watermark for the quarter.
It would define the consensus for months, but that projection was basically obsolete in a matter of days,
Right, because on January 14th, Hina Securities issues a revision.
pushing the profit forecast to 112 trillion won.
The market dynamics were just accelerating so fast that traditional models couldn't track it.
They were trying to quantify a completely new paradigm using historical multiples. It just didn't work.
Fast forward to January 30th, and the numbers absolutely lose their minds.
Completely detached from reality, or what we thought was reality.
IM Securities publishes an update predicting an eye-watering 198.8 trillion won in operating profit.
And target prices across the board from firms like Daishin and Hana smash past the 1.2 million won mark.
Seeing conservative institutional analysts basically double their profit estimates in a 3-week window it's just unprecedented.
What's fascinating here is the underlying mechanism driving those frantic revisions, because it's not just steady growth.
Right.
We're looking at a compounding supply-demand mismatch. If you look closely at the Q4 2025 data embedded in the Hana Securities report, the one from January 30th, the margin expansion is incredible.
Let's hear the numbers.
SK Hynix's DRAM profit margins hit 69%,
Wow, 69%.
and their NAND flash margins approached 30%. We have not seen that specific level of profitability in NAND since the third quarter of 2018.
But unlike 2018, this isn't a temporary spike driven by, a smartphone upgrade cycle.
No, this is a fundamental repricing of the entire asset class.
Which raises the obvious question. When you see an operating margin of 69% on a hardware component, it usually means someone holds a monopoly on a revolutionary technology.
Right.
So is this all just because of artificial intelligence and HBM, high bandwidth memory?
That is the big question, and the answer is complex. Because while HBM is definitely the spark, general DRAM and NAND are essentially pouring gasoline on the fire.
So the AI narrative is almost obscuring a much wider shortage.
Exactly. The manufacturing realities of HBM are ruthless, stacking multiple memory dies and connecting them with through silicon via its highly complex.
It takes significantly longer to process.
Right, and it suffers from lower yield rates compared to standard memory. So because HBM production is eating up so much factory capacity, there is a massive shortage of normal memory chips.
The chips used in everyday servers, enterprise laptops, mobile devices.
Yeah. Every wafer dedicated to HBM effectively cannibalizes the capacity for standard DRAM. That scarcity is explicitly why Hana Securities projects general DRAM prices will surge by 70% in 2026.
70% in 1 year.
And NAND prices are forecasted to jump by 62%. The entire memory ecosystem is being dragged upward by AI.
Here's where it gets really interesting to me. SK Hynix is aggressively expanding their 321-layer NAND to push QLC supply.
Quad-level cell technology.
Right. Now, cramming 4 bits of data into a single cell and stacking it 321 layers high, that is an absurd engineering leap.
It sacrifices a tiny bit of speed for just sheer, unadulterated density.
And you ask, why are they doing that? Because AI doesn't just need fast processing.
No, it needs massive storage.
It needs to hold all that data, the data lakes. You need vast arrays of high-capacity enterprise solid-state drives, ESSDs, to warehouse that training data.
So the architecture for AI is highly bifurcated. You need the HBM for the lightning-fast processing right next to the GPU, and you need the high-density QLC NAND for the sprawling data retrieval.
And the Dacian report outlines Hynix's dominance on both of those fronts.
They are confidently maintaining their #1 spot with about a 50% market share in the HBM sector.
half the market.
Yeah, and they are already preparing the rollout of their HBM4 generation by the second quarter of 2026.
Plus, they are seeing significant upside in their current HBM3 lines.
Driven by the resumption of H200 AI chip exports to China and the broad adoption of NVIDIA's new Rubin architecture, they literally control the choke points.
And that leverage is allowing them to fundamentally rewrite the rules of the game.
Completely.
For decades, the memory chip market functioned as a brutal, cyclical commodity exchange. Buyers and sellers haggled every quarter.
Highly volatile.
But SK Hynix is using this 2026 supercycle to move away from that. If we connect this to the bigger picture, look at the Dacian report's details on sales policy changes.
This is a major structural shift. SK Hynix is actively dismantling the quarterly spot pricing model. They are locking desperate clients into multi-year long-term agreements.
Realty is.
Right, and they aren't just asking for commitments. They are demanding substantial deposits to guarantee allocation and securing advance payments before the silicon even hits the factory floor.
According to IM Securities, some memory makers are floating 100% price hikes to their enterprise clients.
And the clients are actually accepting them.
Because they have no leverage. If a cloud provider cannot secure memory, their product roadmap just evaporates.
Which brings us to a really critical point the experts highlight. CapEx discipline. Capital expenditure.
The old boom and bust cycle.
Exactly. In past booms, chip makers would see these high prices, build too many massive new factories, oversupply the market, and cause a crash.
Crashing their own prices.
But the Dacian analysis notes Hynix is keeping its capital expenditure tightly controlled. They are capping it around the high 30 trillion won mark.
And crucially, mostly directing that toward infrastructure, clean rooms, equipment.
Not raw bit production output. They are meticulously ensuring they do not accidentally solve the chip shortage.
They are managing the scarcity to maximize the duration of this supercycle.
It is highly rational.
So what does this all mean for you, the listener? Let's bring in the concept of BOM cost, the bill of materials.
This is where it hits your wallet.
Break down the IM Securities data for us.
Historically, memory chips make up about 5.4% of the total cost to build a PC or a smartphone.
5.4%.
Right. But by December of 2025, that figure had climbed to 10%.
Almost double.
And if the Q1 2026 prices spike as predicted, that cost burden is expected to hit 18%.
18% of the entire device cost.
Just for the memory. To put that in perspective, the historical maximum ever recorded was 12.7%.
So if a manufacturer is building a flagship phone, and nearly a fifth of their budget is devoured by one component, the math stops working.
The hardware margins are destroyed.
We are already seeing the consequences. PC and smartphone makers are raising retail prices by 10 to 30%.
Or they are secretly reducing the amount of RAM in their lower-end models just to save money.
And it extends to the enterprise side, too. Massive AI server builds could see their construction costs jump by 25%.
Purely because the required memory has become so exorbitant.
This incredible consolidation of wealth brings us to a fascinating cultural buzzword mentioned in the Dacian report.
Oh, this is a great detail.
It's the Hawichi era.
Hawichi.
Right. It translates roughly to Hynix, medical, and dental. In Korea, medical and dental schools are the absolute elite tier, the pinnacle of financial stability and social status.
And now, SK Hynix shareholders are being grouped into that exact same stratosphere of wealth generation.
The market is culturally elevating them. So detail exactly how this cash is flowing to the shareholders.
It's aggressive. Hynix executed a Q4 special dividend of 1,500 won.
Bringing the fiscal year 2025 total to 3,000 won per share.
And more structurally significant, they highlighted the cancellation of 15.3 million treasury shares.
Which is about 2.1% of the entire company.
Erasing that equity instantly amplifies the value of every remaining share. But this raises an important question regarding an even bigger lever they might pull.
The highly anticipated U.S. ADR listing.
The American Depositary Receipt. This is mentioned across several of the reports. Accessing the U.S. capital markets would effectively dismantle the traditional Korea discount that has historically suppressed their valuation,
A U.S. listing opens the floodgates to foreign institutional capital.
which could trigger massive stock buybacks and further skyrocket the company's valuation. Analysts project this could push their price-to-book ratio target from standard regional levels up to 3.0 or even 4.0.
Aligning them with the premium multiples of U.S.-based competitors.
Exactly.
It is a stunning evolution. A single component, the memory chip, has transformed from a cyclical commodity into the absolute choke point of global tech innovation.
You literally cannot participate in the next decade of enterprise computing or AI without paying their toll.
And their technological moat in HBM, combined with their disciplined capex and long-term agreements, ensures this isn't just a fleeting spike.
They have built a sustained structural advantage.
Which leaves you with a final provocative thought to mull over. If the foundational building blocks of AI memory chips become so incredibly expensive that they consume 20% or 30% of a device's total manufacturing cost, what happens to the rest of the tech industry?
That is the ultimate question.
Will this memory supercycle efficiently fund the fabrication plants needed for the future of AI? Or will it make the hardware so expensive that it actually chokes the very innovation that created this massive demand in the first place?
It is a very thin tightrope the semiconductor industry is walking right now.
Thank you for joining us on this deep dive. Keep asking those big questions, keep digging into the forces shaping the tech landscape, and we will catch you on the next one.